Are all these statistics believable? I mean, PPI, CPI, unemployment rates, I mean, their numbers are being thrown at you. No one talks about what's in those numbers, but are they really believable? How you doing, everyone? This is Investing Confidential. We try to peel the onion away and give you some information you're not hearing anywhere else. I'm going to jump right into this, talk about this PPI that came out today. Higher than expected, worse than expected, whatever. Certainly, as we, inflation is sticky. That's the bottom line. CPI comes out tomorrow, but does it really matter if it's 8.3, 8.4, 8%, 7.9? We've had some manipulation of the energy numbers, the gasoline numbers over the last few months. Again, the CPI, PPI are all backward looking. The CPI tomorrow may come in a little better than expected, so we could have a rally, but irrelevant. These rallies are not sustainable. The inflation numbers, even if inflation has peaked slightly, it's sticky. So these numbers are not going to come down to the 2% level of the Fed. They're going to be, 4 or 5%. I've been saying that all along, and I stick to it. But are these numbers really believable? And some of the numbers out there are just not. CPI is manipulated. They'll talk about if the number is higher than expected, they'll say X food and energy. But I mean, give me a break. Food, energy, that's what we're talking about here. So don't believe any of this hype that you hear about these numbers. It's the trend that matters. The trend is still not good, and the inflation front is probably not going to be good for a while. In the short term, again, you could have the CPI could come off a couple of percent. But 6%, inflation is not good. And that's so people, the market may rally on that. But again, all of these rallies are sellable rallies. And I know another rate coming out soon, the GDP. We talked about this number before. They're going to come out with GDP now, all of this malarkey. You can't believe these numbers anymore. It's, unfortunately, and I say this unfortunately, this reminds me of China. Okay, I was investing in China for 20 plus years. The one thing that's constant in China is you don't believe the numbers. You can't believe GDP numbers. You use them. Everyone uses them for statistics, etc. They're not believable. Okay, totally not believable. Totally rigged. Totally fixed and manipulated. And unfortunately, I think the numbers in the U.S. are becoming very similar. One rate I want to talk about now is the one number that the government talks about when they push back against this whole idea of inflation. We are in inflation. We've had 2 consecutive quarters of negative GDP growth. And now you have the pushback, or you had the pushback where, no, it's the unemployment rate. The unemployment rate's as low as it's ever been. That means there's no recession. I mean, give me a break. Let's look at the unemployment rate. What is the unemployment rate? The unemployment rate is created by the Bureau of Labor Statistics, the BLS. Do you know how many people they actually poll? Okay, 60,000 people out of the 300 plus million in this country. 60,000 people are polled to find out the unemployment rate. Okay, someone who doesn't have a job but is actively looking, that's what that person is considered part of the unemployment rate, right? Someone who's doesn't have a job, that is not looking, is not considered unemployed. Don't ask me why. So what is the real unemployment rate? Well, again, everyone has different statistics. You look at what they call the LISEP, Ludwig Institute of Shared Prosperity, does what they think is a more accurate level of unemployment. Their number for unemployment, okay, get ready for it, is 20%. That seems to me more realistic than 3.6%, which is the number that the government uses to push back against recession. So the bottom line is, I don't know whether it's 3.6%. I don't know whether it's 20%, but it certainly isn't 3.6%, and it probably isn't 20%, but it's certainly somewhere in the middle. So the pushback against the recession numbers using the unemployment numbers is absolutely ridiculous. Okay, there's something going on. There's something really bad in this economy, and we're seeing it everywhere. So to say for the government to say there's no recession or we're not in a recession is absolutely absurd. I mean, all they have to do, again, I'll talk about it again, the real estate market. More statistics came out today. Mortgage. Look at this, for example. Mortgage payments adjusted for the median house price. That means you look at your mortgage payment based on the rates today on a medium housing price. But it's just not unaffordable. It's at all-time highs, meaning it's not unaffordable. What's going to happen? You've got institutions that are puking stocks, puking houses, Blackstone and Open Door. I've mentioned this before. They're puking out houses onto the market. People are not buying because it's just unaffordable. So what does that mean? That means houses are coming lower. So when you see in the paper, you see on CNBC, you see in the New York Times and the Wall Street Journal, houses are down, 19%, 15%, whatever the case may be. Well, they are going significantly lower, okay? Because again, this shows you that things are a long way from being affordable again. Talking about, mortgage affordability. Look at these statistics. First, again, this is availability and more importantly, demand for mortgages. First mortgages, purchase mortgages, down 40%. Refi mortgage, refi applications down 86%. This is unprecedented. Okay, what does it tell you? The demand for houses have dropped off a cliff. It doesn't matter who you are. If you're a forced seller or you're a seller in general, you're going to have to take a big hit. And that's not going to happen tomorrow. It's going to take a couple of years. But real estate prices from the peak are going to be down 40, 50% when it's all said and done. Not in the short term, when it's all said and done. So this whole narrative of there's no recession, there's no problems in this economy, this is complete ridiculousness. All you got to do is look at what's happening in the economy today. Look at the housing market, and you will know that the government statistics are lying. Point blank. I'm not going to sugarcoat it. They're all lies. They're all fake. So you've got to do your own homework. You've got to get on everyone has access to the internet, get on the internet and do some research for yourself. If you're worried about these numbers, if the numbers don't bother you, don't pay attention. But if they do bother you, do your own research. You'll find that they're all fake. And they're either, if the ones that are showing you that things are good are worse than expected, the ones that are showing you bad are probably better. Just don't believe it. Do your own work. Now, I'm going to continue to talk about this pension situation in the UK. I've been on this early, and I'm telling you right now, my statements about this, about the contagion effect, meaning it's spreading, are happening today. Here we go. Look at this headline. You've got problems now in Holland, in the Netherlands. Okay, this is going to spread to most of Europe. These pension funds, pension funds in general, are traditionally buy long-dated bonds because they have to match liabilities and assets. So they buy long-dated bonds to match. And at the last 10 years, as these bonds have gone to zero, it's been impossible. So what do they have to do? They have to go to the banks and they have to find leverage. They have to get their rates higher. Bonds have, traditionally pension funds are 50, 60, 70% fixed income. They continue to be that way. But the problem now is the losses are massive. Okay, and if you think it's just Holland, UK, now it's Holland. It could be, Germany, but no one's talking about the US. It's going to come here, folks. I'm telling you right now, it's going to come here. We're going to see some pension funds that have leverage are going to blow up. And who's going to take the hit? Taxpayers. Taxpayers. You're going to wipe out some funds, but the taxpayers and the companies themselves are going to have to pony up money to bail out these pension funds. It is coming. The rate rise in the mortgage market and treasury market is unprecedented. There's a lot of carnage out there. We just haven't heard about it yet. Again, proof. Look at the losses. These are drawdown. These are losses on treasuries. The amount of money that's been lost on fixed income is beyond comprehension. We had, people that have been investing in fixed income, they've had 30 years of a party. It's over. And it's not going to be over for 6 months. It's going to be over for years. So this chart tells you that the losses, and who is buying this long-term pension fund? So the losses are massive. And we're going to see this contagion of the UK spread all over the world. And it's just beginning. The stock market continues to just flounder. You're going to get these rallies. You could get a rally tomorrow with the CPI, but look at this. So this is the Russell 2000, sort of broad market perspective. Medium sized to smaller companies on a weighting basis. we're at, I guess, some kind of support level. But more importantly, look below. Look at the COVID lows. We are a ways away from the COVID lows. As I showed yesterday with China, we're going to test COVID lows. There's no doubt that is the next support level. So if we break here, if we continue to slide, we're going to break. We're going to test those COVID lows. If you rally from here, we're just delaying the inevitable. But at some point, we're going to have to test these COVID lows. So I'm going to end always on positive. What's positive? What do I look for value? Well, if you're looking at relative value, which is I looked at as a fund manager my whole career, we're looking at emerging markets. You could see down the road, there's a lot of things that are going to happen down the road where emerging markets are going to be very interesting. But today, this is where the value is versus the US, versus the West, the developed markets. Emerging markets are trading at a massive discount, not just a little discount, a massive discount on a valuation basis. So as you look at things in the future, looking for value, looking for growth, okay, because this is where the growth is going to be as well. Forget about the US, forget about Europe. You're going to see the opportunities are going to be in emerging markets or companies that have exposure to the growth areas of the world, which is going to be eventually emerging markets. In the short term, with the dollar so strong, forget about emerging markets. Just watch it, just analyze and get ready. Keep your powder dry. With that, traders, happy trading.